Welcome to the Techno Fundamental Report for April the 6th. When the shoeshine boys have tips, the stock market is too popular for its own good. Joe Kennedy. The story goes this way. Kennedy was getting a shoeshine, and this is just a story, whether it's true. And the shoeshine boy was giving him stock tips in 1929 at the peak of the market. He jumped in a cab, went downtown to Wall Street, and sold out of the market and went to cash. Now, what Kennedy understood was human behavior. When things get too popular, like here, it's time to be cautious. I mean, greed, what happens with greed is we end up doing things that we normally wouldn't do, taking risks that we normally wouldn't take. We find that we pick up most new accounts in these types of areas. However, the problem with the emotion of fear is it keeps you from doing anything. It just freezes you. And if we look at this particular survey, which is done every week, every Thursday, we have been below zero. In other words, below zero is fear, above zero is greed. We've been in fear now for an extended period of time. I mean, if you go back and look at the 2008 financial crisis, you can see that we're comparable in time here. So what happens is that everybody gets disgusted with the stock market. They get frustrated. Some people get out, and as a result, then we go back into this process. They get back in at the top, and they get out at the bottom. So it's just something to be aware of. Now, Kennedy also said, when the going gets tough, the tough get going, Now, I also wanted to take a minute. There's a lot of political noise going on right now, and the problem with politics is, and here's Jimmy Carter back in the 1970s, you can really get lost in the weeds with this kind of stuff. I believe, it's my opinion, that the only two factors that matter are corporate earnings and interest rates. So if you were lost in the weeds back in the 70s because you were hung up on politics, you would have missed this. Walmart went public in 1970, October of 70, at $16.50 a share. They issued 300,000 shares at the initial offering. That was $5 million. In other words, this company's market cap in 1970 was $5 million. It's now over, 200, 300 billion. Now, if you bought 100 shares at 16.5 and you held on till Sam Walton passed away, you had almost $11 million. So my point is, don't get lost in the weeds because there's always going to be a wall of worry. There's always going to be something to worry about. Now, I did want to take you back in time a little bit. Today, we're going to do something a little different instead of getting too big on what's going on because we all know it's a negative. This is Tesla. We started buying Tesla back in 2012, 2013. Now, you can see here, you got that gap up buy signal on Tesla. Then you basically would have said, hey, I'm going to put 5% of my portfolio in this stock. And then you truck along, you're doing real well with your 5%, and then boom, you get another buy signal, say, maybe I'll bring it on up to 10%. And that's what we did, and look at how wonderful that experience was. Then we sold the stock after, a substantial profit. Now realize when we were buying the stock originally, it was around $2 a share, and it went to a much higher level. In fact, when we picked it back up again, back in October of 19. Now, we had the COVID crisis in here, but we picked it up back in 19 around $20 a share, and it ran all the way up to 300. We got a sell signal. We sold. Unfortunately, it came down, then rallied, but then has come down again, got all the way down to 100. So this was an interesting story. You just have to really look for, at these times that we're in right now, is where you're going to find these things, because when everything's wonderful and everything's greed and everything's blowing and going, you can't differentiate. But once you get into one of these bear markets, certain stocks are going to pop up. Now, I wanted to also discuss an indicator called the trend lines. Now, this is a primary indicator to us. This is a very important indicator. Each dot represents a week. This is the 35-week moving average. The rule is that if you go above this level, above the 35-week for 2 consecutive weeks, and we're easily 2 weeks above, That's a buy signal. But simultaneously, you have to also have confirmation from the S&P 500. So both the S&P and the NASDAQ need to be above the 200-day for 2 consecutive weeks. And all I can say is I've been using this indicator for many years, and it tends to be right. Now, I did want to take some time and talk a little bit about the banking crisis. Jamie Dimon came out the other day saying that the banking crisis is not over and will cause repercussions for years to come. What he's talking about, if you read into his letter, and you should maybe pause this and go read the report, but what he's basically saying is that the banking industry is really in a difficult position here, especially these regional banks. What happened was the Fed lowered interest rates basically to zero 15 years ago. I mean, it's been 15 years ago since the '08 financial crisis. So rates got real low, ridiculously low, artificially low, actually. And so now that rates are rising, and in the meantime, these financial companies, these insurance companies, banks, brokerage firms, all of them, invested their cash in long-term mortgages and treasuries and corporates and all kinds of things. But it was a long-term investment at a very low interest rate. So what's happening now that rates are up, it's really causing a serious problem. So what I believe is going to be happening here is we're going to see a lot of consolidation, mergers, acquisitions within the financial services industry. Now, I wanted to point this out because we don't really get involved in banks as part of our strategy, and here's why. This was that 25-year study called Eye on the Market by J.P. Morgan, where they went back and did a 25-year study of the top performing stocks. Now, you can see here, consumer-related stocks is half the page. I mean, it's the biggest group. So this would be a pretty smart area statistically to focus on. Energy, I've run into people all the time, and all they do is energy stocks. It's just not that lucrative. Financials, so-so. So the big area is consumer, technology, healthcare. So if you're a focus investor, I would be focusing on those 3 groups. Now, I did want to get more into the banking situation a little bit here. This is a graph of the 5-year Treasury yield. It's dropping like a rock. I mean, it's really dropping here. This is our power index, which has now gone below zero. Now, the whole point of the power index is to say the market's discounting that the Federal Reserve is finished with their interest rate rises. Now, we all know that the history of the Federal Reserve, their error rate is pretty high, so we want to be aware of that. But I would listen more to the discounting of the market, which is telling you that interest rates are going to continue to come down, and interest rates are now in a downtrend. Bank of America, just wanted to kind of point out the graph. It came down, really catastrophic waterfall decline, but kind of looks like it's starting to stabilize in here. If you look at J.P. Morgan Chase, kind of the same thing. So the big banks who are probably going to be acquiring a lot of these regional banks, these big banks are starting to stabilize. However, it's just not something I'm willing to invest in because I think there's going to be a lot of problems, just like Jamie Dimon said. This is the regional bank ETF. You can see waterfall decline, consolidating, but then kind of breaking down again. So there's going to be big changes to the banking industry. I think you just need to be aware of it. It's going to be difficult. There'll be pain. But just keep your head on straight and keep moving forward because, as Joe Kennedy said, when the going gets tough, the tough get going. You just got to be tough. If you have any questions, please let me know.